morning, good afternoon, good evening, traders from across the globe, and welcome to the 759th edition of Short-Term Trading Live with Oscar. Traders, big video. This video is going to be a slightly longer-term view, like a weekend webinar. What I am here to tell you, let's start off with the date, is this video is being filmed on Sunday night for trading the week of August 8th, 2011. Futures trading, as we know, can be extremely risky, and if you've been watching the markets the last 5 or 6 days, you know what I'm talking about. If you do not have risk capital to lose, you should not be trading futures. But for you traders that understand the risks involved, we got a video for you. The last video I did for you on Thursday night for Trading Friday, I left this out on the board and said an unwelcome occurrence in the U.S. indices charts, and I didn't like what I seen and brought out some charts and showed you why we should break down again on Friday. That did happen. Go technical analysis. But a guy like me does not stop when it comes to studying, and I studied this weekend and I thought about it as much as I could, and then I read all the newspapers and then I studied more. And when I did my second set of analysis on Sunday evening, I decided to put something else on this board for you, and that says, although an unwelcome occurrence has taken place on U.S. indices charts, however, there is need to proceed with caution. Proceed with caution here. Yes, it looks bearish. Yes, they are beating the crap out of our markets. Yes, Europe looks terrible. Yes, it's affecting us, and we've been going down. I will tell you this, traders, again, you better proceed with caution. First, remember this. Every summer since 2002 or 2003, we have had a big pullback. May, June, July, and August has been a big pullback. We've seen a big pullback again this year. Not so unexpected. Big pullback, though, and dangerous, and on the downside, but not so unexpected for a summer season. If you look back at the chart, you will see this is every summer. So, we're trading as bears, thinking that we're still in a long-term bull, and then we get the big crack. The market cracks through the weekly channel that was in last Friday's video, which everyone's seen. And yes, we did come down. 4 reasons why you need to be careful here. 1, the S&P cash market and the 200 bar moving average we know is closely watched by the street, and I will show you that in a chart. 2, crude oil. Number 3, the dollar index. And number 4 are bonds. I have charts on each one of those. I will show you why each one of these is a factor in whether or not you need to proceed on the downside with caution in the U.S. indices markets. So yes, I understand that it really does look scary out there, but you must understand that no bull market goes straight up, and there are major corrections. When you get into a major correction, it's okay to trade as a bear, but as soon as you recognize the correction's coming to an end, you must then become bullish. With that thought in mind, the need to proceed with caution is what made me continue to look at my charts. And I started digging deeper and deeper and looking at weeklies and monthlies, and I came up with a reason why, yes, we're going to still sell this market cautiously, but boy, oh boy, are we going to watch for some form of a bottom before this summer is over. It may come quicker than the end of August, but it likely will happen. Traders, I want you to see the charts. I want you to know this. I found this on Metastock. It is my favorite trading program to analyze markets with. If you'd like to be in sync with me and you'd like to use Metastock, traders, I don't know how many videos I've given you with some analysis today that worked out really well. I used the Metastock program to come up with that analysis. If you would like to at least check out a free trial of this software, because the more of you Omniacs that are in sync with me, the better off you will be. When I put these numbers out, you'll be able to find them. Simply go to www.metastock.com/TG7 and take a look at that free software. Now, traders, I want to show you something which I hope to be able to repeat at my seminar. There is a free seminar that I'm going to do this August in 3 weeks, August 20th. It is right here in Vegas, live at the Marriott It's a free seminar, and I am giving away a free $5,000 seat to OMNI Camp. We're going to raffle that off. We're giving out free years worth of Metastock. We're giving out years subscriptions to Stocks and Commodities magazines, and we're giving a free seminar. What would it cost you? Nothing. So come on down and join us at the Marriott August 20th. All right, here we go. Traders, let me show you why the S&P and the 200 bar moving average is important, why the crude oil is extremely important, why the dollar index here is making a decision that could, in fact, affect the way the market goes next in the stocks, and where the bonds are now. Traders, with no further ado, let's go look at some charts. Okay, traders, in my last video before this one, I put this chart before your eyes and many other weekly charts of U.S. indices, and I said, oh my goodness, that is not a welcome development. This is horrible. Boy, oh boy, this could start the beginning of the downside, and of course, we started selling into it for the rest of the week, right? For Friday, at least Thursday and Friday. Then I did more analysis, traders, and I want to show you what I found playing with my Metastock. I always leave longer-term charts up on my Metastock, and I look back for weeks and weeks on end, and what I found was this. If you simply just take that parallel trend and move it from once we made our bottom and we had our first test, if you just take that and call it a parallel trend, we're actually in that parallel trend right now in the S&P 500 and getting ready to kiss the 200 bar moving average while it hits the trend line support. Let me show you another chart. I'll darken up those lines for you. Look, same chart. It's the S&P, the weekly, but if you do not draw the trend line from here up and you just take the meat of the chart, you have a parallel channel that's holding well, and right at the 200 bar moving average, it is right here with Friday's weekly settlement on this weekly bar chart. Traders, that is absolutely reason to move forward or proceed ahead with caution. If we hold here, we will blast off. Now, the last time the weekly bar chart got anywhere near the 200 bar, it couldn't get above and it cracked. When it got above the 200 bar, it came back and tested and took off and made new highs. Now we are back to test the 200 bar moving average. This is extremely important. This week will be an extremely important week to tell us if we are going to become bullish again coming out of the summer, or if we settle below this whole mess and we continue this bear that we've been in for the last few weeks on down for the rest of the year. I think it's going to hold in here, but I'll trade whatever it is they throw at us. Let's look at another chart. Traders, the Dow Jones weekly bar chart, the same chart I put before your eyes in our last video, and I said this is not welcome, right? Well, take a look at the chart right behind it. Simply, all you need to do is just readjust that parallel trend line, and it works really well. And look at how now, what it really shows you is that the Dow is testing support and is getting near its 200 bar moving average, just as is the S&P 500. So maybe, just maybe, we have a saving grace. I am not saying that this will stop the market from dropping. What I am saying is proceed with caution this week. If in fact this week we end up holding here and moving higher, then the market has held and will likely move higher. I say it'll mess around here till the end of August, and then September we'll start higher, but we are day traders and we'll take this one day at a time. Let's look at another chart, traders. Here's where it gets interesting. I mentioned the S&P and the 200 bar moving average, so you've seen that, right? Then I told you that we would show you bonds. This is a 30-year weekly bond chart. So it's a weekly bond chart of the 30-year contract. This is what's called a head and shoulders contract. Here's your shoulder, here's your head, here's your shoulder. It's a head and shoulders formation. The head and shoulders formation on many occasions will get what us omniacs refer to as a head test. That means you form the shoulder, head, shoulder, you hang around here a little while, and then you race up between the middle and the top of the head. If you fail here, that is a miserable failure, and usually the ensuing result will be a big, big breakdown. So, we have the S&P 500 on a weekly bar chart right at the 200 bar moving average and at trend channel support. You have the weekly bonds in a head and shoulders formation doing a head test. If that fails, a big breakdown will ensue. So 2 reasons to think you must proceed with caution, because if bonds break down here, the S&P breaks higher. As bonds have been going higher, the S&P has been going lower. If bonds go lower, the S&P seems to move higher. So we are at a spot right now. Then I mentioned the dollar index. If the dollar index moves lower, it usually pushes the S&P higher, as it makes the price of S&P stocks cheaper and pushes them higher. So the dollar index has already indicated it wants to go lower moving forward, because we had our pennant, we had our false breakout of the pennant, meaning it went up to the false side, the side it will not carry through on, and then finally broke down at the spot we thought it would, the 75% mark, which should show carry through. Since then, it's rallied up and tested the top of this line, failed, and broke all the way down to here, and basically in the form of a bear flag, the dollar pointing lower. So if the dollar is pointing lower, and bonds are at a head test and may stop, and you have the 200 bar moving average on the Dow and the S&P, you have 3 reasons right there where you should be very cautious. Now, the 4th reason, crude oil. Traders, this is a daily bar chart of crude. This is where crude was. This is where it is now. This was 115 or just under 115. Here we are now trading in the 80s, down under 100 into the 80s. You must recognize that lower crude prices is absolutely a worldwide economic stimulus, absolutely unequivocally. There is no way to get money faster into the hands of consumers than with cheaper energy prices. As you go to the store, it's cheaper to drive to the store to buy your goods. It's cheaper to get the goods to the store for you to buy them at. It's cheaper to get the commodities to the companies that are building the product that you're going to buy. It is the best stimulus on the planet right now, because every country, every citizen, everyone who uses energy for any reason, it's an immediate stimulus when it breaks down like this. You will see that this breaking down within a couple of weeks will send the S&P right back up, because that's what seems to happen. When crude has its big ups, we go down. When crude has its big downs, we eventually go up in the stock market. Lower crude prices, a worldwide economic stimulus. Traders, there are my 4 reasons plus my technical picture of why. Yes, we're bearish now as day traders, but absolutely we will proceed with caution from here on out. So, traders, you've seen the charts. There is my technical argument for why we need to proceed with caution going forward. Now, yes, as day traders, the red OMNI comes out. As you can see right here, we got it sitting off to the side. As day traders, we will be looking at the downside, but as slightly longer term minded traders, we are going to proceed with caution. Now, I want you to recognize that it is no joke. The best stimulus on this planet for every citizen who uses it is crude oil. If you push down the price of energy, everybody gets relief. No government can step in and give a stimulus that would work as quickly. Even if you sent money out to half the country, that is not the quickest way to stimuli or to create stimulus in a market. It is lowering the price of your energy. The stores that create product pay less. The people who go get the product pay less. When you fill up your gas tanks or your oil tanks for the winter, you pay less. It costs shipping companies less to move around. It is much better for every country on the planet. So that is QE3 happening right now, and if we keep the price of crude down, you'll see the end result come before this year is up. Now, what does that mean, traders? Many of you have questioned my 1650 call, Oscar. Is it still valid? One thing I will tell you is this. I never, ever, ever shake from a long-term call just because the market is having volatility in the middle of the year. I always wait for the end of each month, see where the market closes on a monthly basis, then reassess whether or not the 1650 call is still valid. As of the close of July, it is valid, absolutely, unequivocally. We still have the call on the board. We'll see what happens in the end of August. If in the end of August there's a reason for me to come in front of this camera and adjust that price, we'll do that. For now, I've seen year after year the markets go 200-300 points against my call, only to come back by the end of the year and reach it. I am not going to worry about it yet. One thing that's beautiful is this: we are day traders overall. We're in and out of the markets. In the morning we're in, we're out by the close each day. So if we, in turn, we stay bearish, we'll stay bearish. If we go back to bullish and head towards 1650, we'll get bullish. Traders, I'd love to teach you how to weave and bob and get in and out of these markets as quickly as we do. We are not scalpers. We never scalp, but we find setups the night before, and the next day we trade those setups. If you'd like to learn how to do that, again, come out to my seminar. It's live and it's free, August 20th here in Vegas. Just come to my site, livewithoscar.com, click the big green banner at the top, and reserve your seat. The seats are free and going rapidly, especially with the traders knowing that we're giving or raffling away a free OMNI camp ticket. So make sure you come on down. Traders, come on to the site and do not trade alone. It's livewithoscar.com. Come on down, jump into my free trading room and allow me to sit there at the helm, live on camera and microphone, and help you traders get through your trades, get through the day, and I share the wisdom that I've acquired in my last 29 years with each and every one of you Omniacs. So come on down. All right, traders, I'm getting out of here. The week is young. I got to get out there. It's Sunday night and see where the markets are now and see what they're doing. I love to keep my eye on markets at night, so we watch them 24 hours a day, of course. I suggest you do the same. Remember, pull your weekly charts. Take a look and see if we actually did break that channel or if you just need to shift it a little. The 200 bar moving average on the S&P cash is right there. It's right underneath the Dow. Let's hope it holds. Let's hope. For now, we'll use this arrow, but we'll hope we can change it. Remember this: S&P and the 200 bar moving average, extremely important. Crude oil, economic stimulus for the entire planet, and it's plunging. The dollar index going lower is buoyant to the stock market, and if bonds do fail at that head and shoulders head test, they will break, giving us a signal that markets will reverse in stocks and head back up. Let's see what happens. Again, the week is young. It is early. We got a lot to go this week. Do your homework, pull your charts, and always keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stop soaring. Emotions are out. Yeah, 759. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.